Whether you like it or not, your credit score is a major factor in your financial life, especially in America where our entire financial system tends to run based on our credit system. And so your credit score ends up being a big part of your life, and it kind of makes a difference. It definitely makes a difference in the things that you're able to finance, the things that you're able to do in life, whether you like it or not. That's kind of where we are. So in today's video, what I want to talk about is understanding what your credit score is, and more importantly, the 5 factors that actually determine your credit score so that you know the things that are either making your score great or weighing your score down. So if understanding credit is something that you want to learn, then you definitely want to stay tuned to this video. We'll be right back. Hey, what's up everyone? It's Channing, and just like I said in today's video, we're talking credit scores. What the heck is this random score that determines whether or not I get to borrow money or not? We're going to dive right into that, but first, if you love the content on my channel, please like and subscribe to the channel so that you never miss a beat. Tell YouTube I'm doing good things so that more people just like you can see it and learn from it. Like I said, we're talking about credit scores in today's video. What the heck is a credit score? Now, your credit score is simply a mathematical calculation that tells lenders your credit worthiness. And these credit score companies, the predominant one in America is the FICO scoring model. There are some Vantage scoring models. There are some competing scoring models. But at the time of this video, the predominant model used in American financing is the FICO scoring model. And when it comes to your credit score, the lenders and the banks are going to look at this score as well as your history to determine what it is that you are able to do and if you are able to finance whatever it is that you're trying to finance, be that a house, in our case, Bayou Mortgage, right? Or a car, a credit card, whatever it is. So if you watch this video today, you're going to learn the 5 factors that affect how your credit score is calculated. And it's going to give you some tips. You're going to understand kind of where this thing is going. And so credit scores kind of come in a range between 300 and 800 or 850. And where you fall kind of in between that metric is going to determine what you're able to do. Typically, if you're under a 600 and even under a 700, you should expect some difficulties in certain areas when it comes to financing things. Now, that doesn't mean you can't finance. It's just your terms get worse. It gets more difficult. They ask for more things, right? Versus when you're 740, 800, things are generally easier. Terms are generally better because that's considered good to great credit. Now, if you have a lower credit score, I'm talking 600, 580, you still have options, right? Especially in the home buying world. But you get under 580 and it's slim pickings for what is out there and what is available to you. You could get an auto loan, but you're probably going to need a down payment and you're probably going to pay a double-digit interest rate. So your credit score affects things. It makes a difference in your life. And so let's talk about the 5 factors that determine what your credit score is, whether you have a 300 and 800 or something in the middle. So the biggest, the largest, the most influential factor in your credit score is your payment history, and that probably shouldn't come as a shock. When you're coming up with a credit scoring model, the bank is number one going to want to know, does this person pay back the debts that they open up, that they incur? And if you don't, then that's going to be the largest factor in your credit score, is the fact that you either do pay back your debts or you don't pay back your debts. It makes up approximately 35% of your FICO score is your payment history, how well you pay back your debts. So if you have late payments, if you have collections, if you have judgments, those things are going to weigh down your credit score because 35% of your credit score is determined by how well you pay back your debts. The next one now is 30% of your scoring model. So they weigh it at 30%, and that's how much you owe. And I think specifically, this is where this gets really important, is when you have revolving balances like credit cards. And so as you max out your credit cards, or as you go over the limit on your credit cards, on these revolving accounts that you may have, you're going to see your score begin to get negatively impacted. In fact, if you exceed 30% of a balance reported on your credit report of a credit card, you automatically start dropping points. You get to 50, it gets worse. You get maxed out, it gets really bad. You max all your cards out, you're talking 100, 150 points potentially that you could lose on your credit score. So those two things right there make up over 65% of your score. How well you pay your stuff back and how much you're charging in the process. And if those things are not right, if you have late payments, if you have maxed out credit cards, those are going to be big red flags to any lender, whether they're a mortgage lender like us or a credit card vendor or a bank or an auto loan lender. It doesn't really matter. If you have late payments, if you have maxed out credit cards, expect to deal with some issues because that's over 65% of how your score is made up. If you have that, your score is going to be on the lower end. The next one, the third one that's weighed kind of the most, and this is 15% of what your score is calculated to be, is your credit history. So how long have you had credit history? If you're brand new and you have this short kind of credit history, that's going to be a factor versus if you've had credit for 20 years. And the interesting thing too, in my opinion, is the longer you've had credit, the more you can absorb negative impacts. So if you had a late payment, if you did max out a credit card, but you have a long history of paying things on time, it can help you, but at the end of the day, late payments are going to suck no matter what. You have one late payment, you could drop 30, 40, 50 points or more. It really just depends. And so the length of your credit history is also important because the newer you are, the more risky you are to lenders. And so you may have difficulty getting certain credit cards if you have a brand new credit history. You may have difficulty getting auto loans. You could have difficulty getting a mortgage. It really just depends on how fresh your credit history is. Lenders like to see someone that has a history of paying back their debts on time and not maxing out all of their credit cards. And then the last two, the next one is going to be 10%, and that's going to be for new credit. So if you go out and you get a lot of new credit all at once, your score is probably going to drop. So if you go out and you get approved for 4 credit cards and you take all 4 of them, when they start reporting, you could see some drop in your credit score because now you're adding new credit to the mix, which is lowering your average age of accounts, which is then now getting into length of credit history and all these different things. So new credit absolutely can negatively impact your credit history. If you get one credit card and it's been a year, like it's not that big of a deal. And again, it's just 10%, but the new credit can affect you. And now here's the other thing is if you go get 5 credit cards in a month, that is a giant red flag to a lender. If you go apply for a loan or something like that, they're going to go like, why did we do 5 credit cards this month? And so the lender's thinking, the bank's thinking, potentially, some will still approve you, so it doesn't mean you won't get approved, but potentially they're thinking like, are you living off of these? Are you having trouble making ends meet, right? Anybody that's a loan officer, if it's not an automated review and they're looking at this, those are some of the questions that they would be asking. And then the final 10% is credit mix. And this is also important. And so if you have only one type of loan on your credit report, let's say you have an auto loan, but you don't have credit cards. Well, your credit mix is going to be affected. And in that particular scenario, you're probably losing or missing out on like 40% because now your amounts owed and your credit mix is bad. And that's 40%. Because your amounts owed is really calculated off of revolving balances. And so if you don't have a history with revolving balances, then you're going to have issues with both of those things. And so by having a healthy credit mix of installment loans and revolving accounts, it's going to help you get a better score. Again, only 10%, but it does make up a decent impact as far as your credit score goes. The great thing about understanding the factors that are calculating your credit score is that you can then take those things and realize if you don't have the score that you want, or if you want to improve your score, then you kind of know what to start attacking directly. The first and foremost would be if anything is past due, work your butt off, do whatever you have to do to get those things paid up to date, because every month you're getting reported late. Ding, 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 ding. Your score's going down. Your score is being dinged until they charge it off or they put it as a collection, and then now you have an added collection, you have an added charge off on to your account. If you have maxed out credit cards, we're going to get those things, right? We got to work hard. We got to get those things paid down, get a side hustle, do some Uber, like whatever you have to do to get those things paid down, because now you're talking another 30% towards your score. So we've actually seen when people will pay down their cards, if they were maxed out, 50, 60, up to 100-point increase just by paying down their credit cards. That's a really, really important thing if you're trying to work on your credit, is to know the factors that are affecting it. And then obviously, if you have a low credit score, the worst thing you can do is keep applying for credit cards, keep applying for new loans. You're only making yourself look worse to the lenders, because you just keep applying for things and you may or may not even be getting them, and it makes you look desperate. And maybe you are desperate, and hey, like, I get it, but don't live on credit like that, because it's going to continue to affect your credit score. It's going to continue to make things worse. And so understanding these factors of what makes up your credit score will help you maximize the score that you have, so that you can have an even higher credit score, that you can get better rates, better terms when it comes to borrowing. Or like I said, if you have a low score that you're trying to fix, you're going to know exactly what you need to do to make that happen. So I hope this has been helpful to you guys. As always, please like this video. Please subscribe to the channel. Listen, if you have home buying advice or credit advice, and you have questions about buying a house, or how your credit goes into buying a house, there is a link in the description where you can book a call with me. I'd love to talk to you for 15 or 30 minutes about how you can get ready to purchase a house in the next year, in the next 6 months, in the next 3 months, whatever it is, whatever your goal or timeline is. So I'm Channing, and I'll talk to you next time.